As an investor, my guess is a good deal of your portfolio will be in stocks and bonds. These are the two primary types of investments for most investors. Knowing the difference is critical in your journey to be truly wealth ready. You may already have a good grasp on what a stock and bond is, but stick with me for this short video, as there might be a good nugget, maybe chicken nugget, or two of new information you'll learn. Okay, what's a stock? A stock is ownership in a company. All right then, what's a company? A company is a separate legal entity that exists apart from its owners. While the owners of a company are mortal, a company is eternal. Think about Apple, the company, not the fruit. Steve Jobs passed away, but we still got the new version of the iPhone because the company continues to live. A company is like a person in that it has certain rights and responsibilities. Again, separate and distinct from its owners. And unless you live in certain progressive countries like the Netherlands, New Zealand, or Germany, another key difference is a company can sell itself, but a person cannot. This is where the idea of stock comes in. It's kind of simple if you think about it. When a company is started, the owner or owners decide how many shares of stock the company should have. It could be just one share, or it could be 1,000,000 shares. And they can change their mind and start with one share and then change it to more shares. While a company, for example, take McDonald's. No, really, please take it. McDonald's can own lots of stuff, like buildings and trucks and French fries. The company itself, though, is its stock. If you want to invest in McDonald's, you don't buy a vat of their special sauce. You buy shares of McDonald's stock. And by having just a single share of McDonald's stock, you actually own a small piece of not just their not so special sauce, but everything the company owns. Check this out. So when you own McDonald's stock, you actually own everything that McDonald's owns. You own all their hamburgers, their French fries, their special sauce, the buildings they own, the real estate. Everything that McDonald's owns, you own just by owning a single share of McDonald's stock. So that's cool, isn't it? But why would you want to own stock in a company? Well, you want to make money, of course. But how? You expect the company to make lots of money. You expect them to sell lots of burgers and shakes. And if they do, then your little slice of ownership becomes more valuable. But keep in mind, when you own something, that something can go down in value. Stocks can lose money. There are other kinds of investments that don't lose money, but as a stockholder or shareholder, you definitely could lose money. Stock is also called equity. It's ownership. As a stockholder, as an owner, you get special rights. You get to vote on important company matters, show up for their annual meetings. And even you can get income in the form of dividends from their profits. But sorry, you don't get a complimentary Big Mac. This is actually a painful reminder of the time I took my daughter to Disneyland. I told her we owned Disney stock, which meant we owned a little piece of Disneyland. The initial look of admiration on my daughter's face was what a parent longs for. But it quickly faded after I told her this didn't mean we could get a free Mickey Mouse pretzel. The takeaway: stock is ownership. If you own a share, you own part of the company and a piece of everything the company owns. You could do many things with your money, but when you invest in a stock or stocks, you are making an educated decision and placing your money on the management of the company, the people who work there, the new products or services they're going to offer, and of course, their profits. In essence, you are investing in the future success and growth of the company.